Welcome to the Brain Wealth Podcast. This is Bryan Repple with Repple Wealth Group. I've got an exciting show here today. This is a conversation I've been wanting to have for the last couple months around a topic and a guest I've been looking forward to bringing on to talking about this financial instrument tool that is so vital and critical for retirees, baby boomers, and the challenges and the opportunities they face in this next chapter of life. I have I'm going to call it someone that's been in the industry, the financial industry, for over 30 years. George Vrban. Am I saying that last name right, George?
Vrban?
Vrban. Yes, George Vrban. And George has been in the industry for over 30 years, insurance and mortgages. He specializes in this conversation we're going to talk about, reverse mortgages. So I hope faces didn't get red, the body did not vibrate too much when you heard that term, because we're going to have a fun conversation talking about reverse mortgages, the myths, the opportunities, the tax advantages, and how you can live your life abundantly. That's what we really try to promote here on Brain Wealth. So George, let me just get right into it because I want to hear about you. How did you get into the industry? What's a little bit about your backstory that you can share with our audience?
Yeah. So thanks again for having me on the podcast there, Bryan. The big thing that, first of all, I've been doing this for about 20 years, but back in 2002, kind of stepped out of the insurance industry back then and back in the day. And my friend convinced me to get into the mortgage industry, and wasn't a real big fan of what they call subprime loans back in the day, back in the 2002. I wasn't totally impressed, but I was trying to figure out what was that niche, right? What was that area that I can help people out? And then I heard about how reverse mortgages can really help out a lot of clients. And so I kind of stepped into that role about 2005, 2006, and really have focused on being a big advocate for people 62 and over, figuring out how do I help people make their money go further in retirement using housing wealth as part of that retirement strategy. And obviously by doing it for as long as I have, where I kind of separate myself from most people is I do teach it as a retirement strategy. Unfortunately, people in my space don't necessarily accurately convey this as a retirement strategy, but that's the difference. What I try to do is kind of work alongside people like yourself, Bryan, where we can team up and figure out how to help these people out. So, but yeah, that's kind of my background.
George, you just said some great stuff in there. And I hope, because there's some words you use that I think are so critical that should be expanded upon. And one of them is housing wealth. What a big word. And let me explain, because one of the things about housing wealth is there's roughly, maybe you can clarify this, but maybe $6 trillion sitting in untapped equity capital of baby boomers' homes.
13 trillion.
13 trillion. Okay, so this number's outdated. So double that, $13 trillion of untapped capital. That's housing wealth that these baby boomers have access to, but they're not tapping into it to live that next chapter of the life. The other two things you said was retirement strategy. Now, let's just talk about that real quick. Let's talk about the problems first that baby boomers face. What are some challenges that you see as a retirement specialist in this field that you see baby boomers facing in that next chapter of the life? Maybe just name a few, and I'll even drop in a couple myself.
Well, first of all, I'm 61, so I'm part of that baby boomer generation. And a lot of people, we just been brought up on fixed rate loan, pay off the loan, mortgage burning party, give the house to the kids. That's just what we've been brought up on. I don't know if people realize this, but where that came from was people back in the 1940s and 50s were only living into their 60s. So when they passed away in their 60s, the kids would take advantage of the house and keep the house. But the dynamic that's changed today is that people are just living longer, right? So we have people living in their 80s and 90s. The kids are in their 50s and 60s. So when parents ask, hey, you want the house? Guess what they say today? No, they don't. They have no interest in the house. You know what they want, though, instead, right?
They want the money.
They want the money.
Show me the money.
But this is just what we've been brought up on. And we're still kind of stuck in that stigma of people thinking that the house is a way to leave a legacy. And there's other ways to leave a legacy. And we'll go into that a little later. But I just want to talk maybe about some of the misconceptions, right? So first, that people, they always ask me this number one question is, hey, George, I heard about this program. Do I lose title to the house? Does the bank take my house? All that kind of stuff. And I'm like, no, they have no interest in your house. This is nothing more than, it's called a home equity conversion mortgage. It's nothing more than a home equity line. A lot of people didn't know that this is an FHA loan. So it's a government insured loan where they have these protections in place to make sure people don't get taken advantage of. And, can you make a payment on a reverse mortgage? Yeah, you can make a payment if you want, but you don't have to, because it was designed as an optional payment program for people 62 and over to free up their Social Security check. So they're not spending it on a mortgage payment to free up more cash flow in retirement. That's what it was designed for. So when do you pay it back? Well, you can pay it back while you're in the house. You can wait till you sell the house. You can wait till you both pass away. There's no urgency because there's no prepayment penalties on these loans. You can do whatever you want.
So wait, let me get this right, George. There's no payment. You're not forced, or you don't have to make payments back on this loan. Wait, did I hear that correctly?
Yeah, you heard
So
that
you're
correct.
able to tap into the equity, this housing wealth. You're able to tap into it, have access to it, and you're not required to make a payment back. You said that?
No, not at all. Now,
and that's backed by the FHA, the government, you said?
yes, and this is probably one of the safest loans you're going to find, because I'm going to dispel a lot of other myths that people have in this product. So, no, this is probably one of the safer programs you're going to find out there in the United States, with all these protections they put in place. But what the family does with the house is a family decision, though. It's not the bank or the government. They have no interest in the house. So the family gets to decide what to do with the house. That's a big misconception that's out there today. They just think the bank takes it over, the government. I'm like, no, the family gets to decide what to do. So that's the first one that people always ask me. The second one is, how does it really work? Well, what they do is they just take the age of the younger of the two borrowers and basically give them a percentage of the appraised value, not the equity position, but the appraised value. And let me give you numbers as an example. If the house is worth 200 grand and I loan 70, it's because the age dictates how much I can loan them of the appraised value. The question is, do they have a mortgage? If they have a mortgage, and let's just say they have a 50 grand mortgage, well, we got to take 50 of the 70 we're giving them. We have to pay off that mortgage. It replaces that other mortgage, so they don't have a payment anymore for the rest of their life. But then they have an extra 20 grand to figure out what to do with in retirement.
Let's just go through that right there. That's a great example. So if someone's 65, 66, or whatever, the number, and they have a mortgage, and they were to use this strategy and access $70,000 out of a $200,000 valuation on their home, they could pay off that 50,000, now free up that cash flow, and have $20,000 available for a cruise, home renovations, whatever it may be used for.
Correct.
And they don't have to make payments back?
No, they don't have to make payments. They can pay it back at a later date. So and there's many different ways to receive the funds, right? You can get a lump sum, a line of credit, or a monthly payment. And there's some fascinating features that are in those three options that I kind of go over the pros and cons. But I kind of skip to number 3. The other misconception people have is on number 3 is inheritance. Can the kids inherit the house? The answer is yeah. It's no different than any other mortgage. They just got to figure out how to pay it off and then keep the house if they want to keep it. But if they don't want the house, they just got to let the bank know within 30 days what they want to do. So if they want to sell it, they'll say, okay, well, you got up to 6 months to settle the estate, pay back what was borrowed, and then whatever money's left, the family keeps. It's no different than any other mortgage out there. It's just that, again, people hear these stories, they're not accurate. And what's interesting is you can get 3-month extensions up to a year if you have to sell the house, just to go ahead and sell the property if you have to in that case. So, but inheritance, that's usually what people ask me as well. So that's the third. The fourth is a lot of misconception too, is closing costs, right? So closing costs are more on a reverse mortgage because it's not a conventional loan, it's an FHA loan. The government insures the loan, so 2% of the 5% of these costs goes straight to the government because they're insuring the loan. But let me give you a worst case scenario. I know financial planners always ask me, George, give me a worst case scenario. Give me an upside down. Give me something crazy. So I'll give you a hypothetical that doesn't happen too often today, but I'm going to go there. Let's pretend that house is 200 grand. They borrowed 70. They never paid it back. They're like, who cares? I don't have to pay it back. I can live in the house for the rest of my life as long as I pay my property taxes, homeowners insurance, and upkeep of the house. Those are the only 3 rules. As long as you do that, you can stay in the house for the rest of your life. Now, let's say that interest on that 70 grand went from 70 20 to 25 years later, it grew, and the loan balance now is $200,000. So they owe more, obviously, because they're not making payments. Interest accrues on the loan, gets paid back at a later date. So let's assume it's 200,000 20 years later, and they both passed away, but the market crashed. The house is only worth 150. So now it's upside down 50 grand, right? And I always ask clients, I go, who do you think writes that check to the bank when that time comes? Is it the kids? Do they come after the assets up for that upside down 50,000? And guess what most people say?
I'm thinking that they think the kids are going to have to pay the difference.
Yeah, sometimes the kids, or believe it or not, a lot of them think they're going to come after their assets. And
Yeah.
the answer is neither one.
Right.
This is a non-recourse loan, which simply means that whoever's left behind is not responsible for the debt. It's the only loan out there today where the house pays back itself. The house pays back the loan, not the people left behind.
And that's when I heard that a couple years ago from you, that was such a driving factor saying, wow, what's been created right now in the marketplace to protect the families of the boomers and their housing wealth was that non-recourse loan. That was such a critical, it's a great word, but it has a lot of meaning to protect the family and their wealth and their kids.
Correct. Yeah. And what's interesting is people think that they come after the assets. I'm like, no, that's the best part. They can't touch any of the assets like bank accounts, savings accounts, 401ks, IRAs. They can't touch any of that. So who writes the check? It's actually FHA. The government writes a check to the bank for the difference. But that's why the closing costs are more, because that extra 2% was an insurance policy for the parents, that if they do this strategy, it was peace of mind for them knowing they're not passing debt to their kid.
Well, George, let's really talk about that because you're right. People do get hung up on the closing costs. They generally in the very beginning, the first thing they get hung up on is just the word reverse mortgage. They're like, you see them get squirrely and they're like, wait a minute, let's understand how these instruments work, but specifically, let's understand how it works for you because people are living longer. They need access to capital for healthcare purposes for life. So we know that there's need for this capital. They don't want to have a payment back. So that solves that problem to have access to the capital without making a payment. Now, when we talk about the fee, the closing costs, and people get hung up on that, and you're saying, yeah, it's a little bit more because you got this non-recourse feature to it. So we got this protection. You're paying for this protection. But more importantly, let's think about what you're really getting when you access this capital. 2 words, tax-free. Tax-free. So if you're pulling money out from an IRA or taking distributions from an asset that you have to pay taxes on every year, those taxes go against your Social Security income, which you pay taxes on Social Security. If you have too much income, it affects your Medicare, costs go up. Mm-hmm. And we're looking at a tax-free resource that you have available. You're sleeping on it every night. You're eating dinner on it. And it's untapped tax-free capital that can be used to reduce taxes potentially, or reduce or eliminate, or complement.
Yeah. And a lot of people, I'm a math guy. So I have my own financial planning software, and I show clients that, you're not physically paying these costs. The only cost out of pocket is a counseling session that runs about $155 and an appraisal fee, which can run about $600-700. But that's it. Everything else is rolled in a loan. So what are we using? We're using equity to fund these costs. So we roll it into the loan. Now, what makes up for it? Here's the key piece. I call it an arbitrage. Basically, the longer you stay in the house on this program, the better, because what's offsetting all the costs is if the property value only goes up 2%. Now, most of the country today is between 4 and 10%. But I only do 2%. I'm like ultra conservative. So I can show the math that if people just stay in their home for a period of time, the value on the other end makes up for the closing costs associated with the loans because they're not paying for it over here. They're on this side of the bucket. The value of the home is offsetting all that. So they'll make up for it on the other side. So that's the part I also try to prove math-wise that it's not what people think.
That's great because you're proving it now math-wise on the home just with that.
Right.
Then you integrate the other part of planning, tax strategy planning, distribution, Social Security tax, Medicare costs. You're probably reducing that those dollars are getting much more reduced over time dramatically, I would think.
Correct. Yeah. And that's why I tell people, if you're planning on moving, or if you're not going to do this loan for more than a year and get out of it, well, then I don't recommend it, because now it's an expensive loan, because now you're physically paying those costs, right? It doesn't make sense to do it then. But people didn't know this also, which I'll tell you is a couple stories. People didn't know you can buy a house with a reverse mortgage. They're like, what? I'm like, yes. So I can show you that it might not make sense to refinance if you know your plan or your goal is to get out of the house within a year. Well, then we need to shift gears, right? I'm as fluid as a financial planner. I come up with different strategies all the time. And one of them is, it's called right sizing. I don't even like to call it downsizing. Right sizing, meaning first floor, no maintenance, right? Less costs. We're in our 70s and 80s. We don't want to go upstairs. So I can show clients how to physically buy the right house with this concept and have no mortgage payments for the rest of their life, but keep more money in their portfolio that people are missing the boat on, and have more money in retirement, right? Because the goal in retirement is not to die with the most home equity. The goal in retirement is to have more cash flow, because we're living longer today. We've got to figure that part out. That's where the paradigm shift is taking place now.
So let's go to that right sizing. Now, I know we've worked like a case together with one of my clients that was in the process. They sold a home and they were looking at, well, let's walk through the case, because it is a fun situation. We've done a video with them. They've been open about sharing their story, and we've shown their story to our financial advisors and to clients. So they've been open, but George, I'll use his name, is sold his home, and he was looking at, not you, George we work with, but sold his home and was looking at how does he take the capital to sell the home. And they were looking at purchasing a new home. And the home they were looking at purchasing was going to be more than the previous sale of the home. And I said, well, and they didn't want to do a mortgage because they only knew two options. So let's think through the traditional two options. One, pay cash, take whatever other money out from your savings and investment dollars, maybe pay taxes on those to buy the property. Or two, go and finance up, whatever amount you can get financing on, and have to go through that fun process of going down to the bank and exposing everything about yourself to the bank to ask for some money. Those are the two traditional options. Well, we showed George and his family. They came in, and the first conversation was, no way, what is this? We don't want this. We're going to do it the old way. We said, wait, let's just understand. Let's George, let's just walk through the strategy. Let's just hear it with open ears and just see, can it work for you? And let's understand how these new instruments are done. Now, I'm saying that because that did take place. We had to have that conversation because so many people are saying, no, I only know this way. We went through it. They were able to go get the new property. They only put half of their original cash into it. That means they kept more of their money. They purchased a new home using the HECM strategy, the reverse mortgage strategy, get the new property, and they kept capital with no mortgage payments.
Yeah, I mean, and there's other strategies too, right? So I work primarily with clients with very little money to my average net worth of my clients up to $5 million. I've done reverse mortgages for them. People are like, why in the world would somebody with $5 million want to do a reverse mortgage? Well, nobody wants to donate to the government. So we're all trying to find creative ways to do some tax strategy planning. The mistake most people make is they pay for a house cash. And if you do a home equity line or even a reverse mortgage after the fact, that tax code is called home equity indebtedness. That tax code is gone. You can't write off any of the mortgage interest. Yes, granted, there's a standard deduction and there's itemization, but I can teach strategies on this concept on both sides. It doesn't really matter. And we're not going to go in great detail because that's where we can spend more time with these clients. But this is part of the strategies. We're trying to show people, look, why don't we use 2/3 of your money, put that as a down payment. We'll finance the other third, help you bring less cash to the table, buy more of a house, get the right house, not settle for something that you're not going to be happy with, but buy that house in that neighborhood you really want to buy. I'm accomplishing the exact same goal, no different if you pay cash, because this doesn't require a payment. But then it goes further. What people are just not familiar with is looking at the portfolio, looking at qualified money, looking at, how do we offset some tax liability for down the road when you do have to pay a tax? Look, you're going to pay now or later. Question is, how much are you going to pay later? Well, if we can show you another creative way to get some tax advantages here by using this product the right way, that's where I work alongside the financial planner. When that tax event occurs, people will call me and they say, "Hey, George, we got a major tax event coming up. How do we use the reverse now to get a nice big tax deduction to help offset this tax liability?" So we're not going to go into great detail on this call, but what's interesting is I have strategies for clients that have a free and clear home. And then I have strategies for clients that have a mortgage. So I'll give you an example, 5 quick examples of people with free and clear homes. When you have a free and clear home, when I work with a financial planner, it's called number one is sequence of returns risk. I get a lot of people when the market's down, right, Brian? People come to you and they need money, but they're pulling it out at the wrong time. The market's down. The last thing you want to do is pull out money out of your portfolio. First of all, you get taxed. Number two, you just took a major hit on the probability of your money making it to the age that you are looking for, having that X amount of money for retirement, just took a major hit. So it's going to take that much longer to recover. So why don't we use some of the factors here or some of the advantages of this concept to leverage, use tax-free money on this bucket. And then what we do is physically let the portfolio, let the market recover. So we make that probability of that money going further a greater chance, right? So sequence of returns risk is number one, is showing how to leverage. It's all about liquidity, use, and control. All a reverse mortgage is, it's just liquidity. It's you have control, and you get to decide how much you want to use and spend. So you have total control. It's just that people are just not aware of all these strategies, and people are not educated how this product really works. Number one. Number two is LTC, long-term care. I can't tell you, in the 20 years I've been doing this, I can't tell you how many portfolios I've seen get destroyed from healthcare costs, completely get depleted. And here we're looking at a wonderful, beautiful asset of $1 million or a $500,000 house free and clear. When we can fund in-home care, because a lot of people are unhealthy, they don't qualify, it's too expensive. We can't get them a life insurance policy with a long-term care rider. We can't do any of that stuff. But we know that that person's going to incur costs. The very first place people want to dip into is the portfolio, right? But if you do that, what ends up happening to the retirement plan for the person that's healthy? It just blew up their plan.
It blows up. Yeah, it's gonna bleed out.
It's going to self-destruct. So we're saying, wait a minute, why don't we use the house as an asset to fund in-home care that can solve that problem, but it's all tax-free money. It doesn't have to be paid back till a later date. Protecting the portfolio, pushing the money out as far as I can to help the person that's not only unhealthy, but the person that's healthy, and helping them keep their money as long as I can help them. These are just some of the simple strategies that I do with this concept. And that's number two. Number three is traditional IRAs, converting them into Roth. Believe it or not, I have strategies for that. I've paid down margin accounts. I've done a couple of those. People borrowing off their portfolio at a crazy rate right now that they're bleeding through their asset. Also, believe it or not, people didn't know this, but you can fund a life insurance policy with these premiums from the reverse mortgage. Look, I'm not an insurance agent. I'm just trying to tell you that one of the better ways to leave a legacy is life insurance. It's paid in tax-free 30 days. I know I'm worth definitely more dead than alive right now, because I have a lot of life insurance on me that if something happens, my wife's taking care of, the kids are taken care of. The house is out of the equation. I took the house out of the equation. So it doesn't matter. I'm leaving other ways to leave because they don't want my house.
Tax-free too. They're tax-free.
And it's all tax-free, right? 30 days tax-free. So you can do all those strategies for clients that have free and clear homes that people are just, that you can plug in so many more holes.
Let me drop number one of the other ones in there. Or it can just be used as a play check. You can have fun with the money. You can improve your home. You can go live life. It can take pressure off other areas of your assets, because this is a tax-free asset that you can tap into to live life and have fun.
Or you can just use the house to pay for the house. Why are we using our physical cash when we can use that in retirement?
Right.
When you can use the concept that I show, if I can show you ways to pay your taxes, your insurance, HOA dues, and go take a trip once a year without using any of your cash, would you be interested? I don't know if anybody wouldn't, right? I mean, it's just that people are just not aware of this stuff. So those are the common strategies, but people that have a mortgage, it's very simple. It's two strategies. We free up cash flow, so we have more money available in retirement. What does it do to your portfolio? It avoids it from spending down or pulling money out of there because I just redirected your money. You're putting more in your pocket in retirement, avoiding spending down your bucket that you're managing. And then we play the tax strategies on people that have a mortgage. So those are the simplest ways I can explain this in a very short period of time. But going back to number 4, closing costs, that hopefully that clarified that piece, which leads to number 5, which is just fear, just absence of knowledge. People do not understand how this thing works. That's why it's so critical. I love working right alongside you, Bryan. So that way people like yourself, where we can converse back and forth and how do we help this client out down the road. Strategies change. I got 2 stories and then I'll see if you have any more questions, but let me give you 2 stories that I've done with this concept. Number 1 is strategies change. Today's strategy might be cash flow. I did a reverse mortgage in somebody in Orlando where I helped them free up cash flow. 3 years later, the wife calls me up and says, George, I need another strategy. And I go, what's that? They said, what happened? They said, well, John died. I don't want to stay here in this house anymore. I want to live closer to my granddaughter and my daughter, and they live in Castleberry. Can you help me, figure out the next game plan? And I literally showed her a plan where I helped her sell the house to where she paid back the reverse mortgage. I took some of that money and put it back in her retirement portfolio. So I put some money, captured some of that housing wealth, put it back in her portfolio for retirement. But then I took the rest of the money and I helped her put it down as a down payment to buy her future home with the reverse mortgage. She lives down the street from her daughter. She has her own place. She right-sized her house, no mortgage payments. I put money in the bank, and we accomplished all those goals by just simply using the product the right way. And now she's so happy. She don't want to live with the kids. A lot of parents don't want to live with the kids. So she's right down the street, has her own place, has her own space, no mortgage payments, and we put money in the bank for her.
That's awesome. Let's hear the second story. That's what I just heard out of that one, and I hope the listeners did too. Was flexibility,
Yes.
control, and choices.
Yes.
There's a line that I learned a long time ago by reading Robert Kiyosaki's book, Rich Dad Poor Dad.
Yeah.
I was coached by the rich dad in real life. His name is Keith Cunningham, and Keith's line that I heard, this has stuck with me for so long, is saying the wealthiest people are the ones that have the most choices.
Yes.
And what we're doing right now in this conversation with George and I is we're showing you he said housing wealth. It's showing you how you can have more flexibility and choices with capital you're sitting on and tapping into that. And it's just not one way of doing it. George has multiple strategies. He's just shared one client example. I gave flexibility in her choices so she can have the outcome and freedom she was choosing to. George, let's hear the second story.
Yeah, it's interesting. I use that same concept, by the way, from Keith. But you're right. A lot of people that have more money have more options and they get to do more stuff with the strategy side of it. But the second scenario is where I had a client that was bleeding through his IRA and literally pulling out 25 grand a year every year because he goes, George, I'm not going to wait. I'm not going to let the money sit there till I'm 80, 85 years old. By that time, I'm not going to be able to do anything anyway. It's like I can't go around doing anything. So he says, I want my money now, and I want the money to be pulled out every single year so I can go enjoy my life with whatever's remaining of my life. Well, the financial planner said, if you do this, your money's going to run out and you won't have anything left after so many years. He goes, you got $1 million house. Go talk to George. He'll teach you a strategy that can solve all the problems. So there's a fascinating piece about this that people are just not aware of that I'll go in greater detail if you reach back out to Bryan or back out to me, where I literally showed him how to pull out 25 grand a year tax-free for the next 10 years. And we were able to not only give him a big chunk of money available, it was the same amount of money that was available 10 years later, even after pulling out $275,000 10 years later. But the 275 was tax-free. And I helped solve his problem of having that extra money that doesn't require a payment. There was tons of equity still left in the house 10 years later. But the most important thing, what I did also is, what did I help do to the IRA?
You preserved it.
I preserved it. He didn't get taxed. He let it stretch out. And 10 years later, his IRA is going to be so much higher and more because he's not pulling the money out. I just showed him how to redirect some of his cash. And I pulled it from the housing wealth and helped him take care of that particular strategy instead of bleeding through the IRA.
George, this has been great. I know you and I can keep going down. There's so many topics around and conversations around this subject matter
Mhm.
of the risk, living too long. We started to even talking about a little about healthcare, life insurance, just living life with these assets. I think the greatest thing I really know you communicated was these instruments, what they used to be, they're not today. And that's, I think, the biggest message I hope people get across is saying what was designed 20 years ago, it's not the same instrument today. And there's protection, there's liquidity, there's use, there's control. And one of the lines that you and I both know this line is if what you believe to be true turned out not to be true, when would you want to know about it? You'd want to know today. So that's why we're having this conversation because I've sent clients to you, George, and it's always funny. The very first conversation is always like, I don't know about this, to the very end saying, thank you.
Yeah, exactly.
It's
Yeah.
it's such a cool transformation because I know what you are doing in the middle, just so everyone hears the process, not the full process, but the ideas to get together. What we do is I will sit down with you as the advisor. We're just going to gather the information, and then we bring George into the conversation. And from there, George and his team will navigate. They're gonna handhold, educate, work through what is the plan and the strategy for you. What's right for you, the client. There's multiple. If you're looking at moving, you're looking at selling your home. You may have a mortgage, or you're free and clear, and we're just looking at a strategy to access capital to bring in additional income, tax-free, to take pressure off other assets. George is going to listen to those things and guide and work through that with you and provide. There's a lot of education that goes into this. And that's part of the fun behind it because you're learning something about your money and you're learning something new and overcoming a myth and a belief that may not be true. And that's fun to grow. That's where abundance takes place. And that's what we're really striving for in Brain Wealth is to bring abundant ideas to unlock opportunities for your wealth and your freedom. So George, thank you so much for being here. That was an incredible job. I know we got the message across and I know we're going to impact lives and share these financial principles with any last words from you?
No, I just I give credit for people like yourself, Brian, because there are so many financial planners out there that are still under the old school of thinking, and they're missing out on what I believe is one of the best retirement tools. When people, and I want to make sure people hear this, it's the fiduciary responsibility of a financial planner to investigate everything that they can find out there to help improve your portfolio. And Brian has more than done that. He's done the due diligence, he's done the research, he's figured out the math. It makes sense. Now what we're doing is trying to team up and figure out how do we help you get educated on the same concept. So Brian, kudos to you again and your group, just to being open-minded and understanding how this concept can really make a difference in people's lives. So thank you for doing that.
Yeah, absolutely, George. You've really helped educate me a lot. And that was part of that due diligence of seeing and listening to you go through cases with the clients. One of the books that George has sent me, and I have them at my office. If anybody ever wants to email and ask for one, that really helped guide me was Home Equity and Reverse Mortgages, the Cinderella of the Baby Boomer Retirement. There's a lot of education there, breaking down myths, the problems, and then the opportunity. And that's what we need to go through that sequence to get our minds past what we may think and believe to be true is not necessarily true today. And we need to get through that sequence and to find the opportunities for you and your family. Thank you for being on the show here today, George. That was great. Anyone
Awesome.
that's interested in learning more and going through the process, please reach out to repplewealthgroup.com. That's repplewealthgroup.com. Schedule an appointment. I will sit down with you myself. We'll walk through your particular situation. And then I will bring George and his team in, and they will guide you to the Cinderella of retirement for the baby boomer there. So thank you so much, George, for being on the show. And we look forward to you working with more of our clients.